10-year note yields open the week continuing to move higher, today getting all the way up to 480. Taking a step back and going back to those December 6th lows just prior to the November employment report, we've seen 10-year note yields rally over 65 basis points in just over a month. So a big move in a not short amount of time. Seeing yields continue that trend again, getting up to 480 before backing off and closing out at 478. Now, since that time, obviously the Fed has cut rates once, but after we saw the strong employment report last Friday, Fed expectations have turned, and now we're looking at the possibility of only one rate cut in all of 2025 as we speak currently right now. So those 10-year note yields moving higher may reflect some of the risks of higher inflation versus the weaker growth aspect, which I think was winning prior to last week's stronger than expected employment report. And again, seeing 10-year note yields rally today, getting all the way up to 480 before closing out at 478. Now, what does this mean for volatility? Well, check out that CVOL index over at cmegroup.com. And volatility opened the week moving higher, moving in tandem with yields, something we're used to seeing on a historical basis. Now, volatility has been creeping higher since the middle part of December, only seeing a few down days, but it hasn't seen a big spike up or down, but has been slowly climbing ever since the mid-December area when yields were starting to pick up their steam and moving higher. So again, seeing yields move higher and volatility moving higher as well. Lastly, let's talk about what we have tomorrow. Tomorrow's Tuesday. We get the PPI number, sort of a preliminary inflation look for CPI, which doesn't come until Wednesday. We also get the NFIB Small Business Activity Index, as well as Fed speakers coming out. We get Kansas City Fed Schmidt speaking in the morning. We get New York Fed President Williams speaking in the afternoon. And the market obviously will be waiting to see what happens with PPI, how things may shift for rate cut expectations, which have been moving again lower, now seeing only one rate cut fully priced for all of 2025.